All right, let's get straight into it. Today, we are taking a hard look at the state of crypto here in 2026. And I mean, forget everything you thought you knew about meme coins and overnight fortunes. The whole landscape has grown up, the rules have totally changed, and believe me, the smart money is playing a completely different game now. And look, that right there, that's the main idea we're diving into today. The whole era of chasing some anonymous dog-themed token for a quick flip, it's not just ending, it's over. The serious capital, the big institutional money, they are not looking for hype. They're looking for real yield backed by real-world things, by law and steel. We're talking about the bedrock of the old financial world. Bonds, real estate, private credit, all of it being brought onto the new digital tracks of the blockchain. And the difference is just night and day. We have moved from a market completely driven by hype and anonymous influencers to one that's actually built on utility and real-world cash flows. Those Wild West days with zero rules and just this retail-driven craziness, they've been replaced by a structured, institutional arena. The new game isn't about who gets in first, it's about investing in sustainable, value-driven assets that actually do something. Okay, so here's our game plan. We're going to start with the big picture, the new rules and regulations. Then we'll zoom right in on the assets themselves, sorting the real value from the speculative vaporware. We're going to uncover a brutal truth about where yield really comes from, then give you a timeless framework for making smart decisions. And finally, we'll put it all together into a modern portfolio strategy for 2026. First up, the new landscape. And honestly, this is probably the single most important shift in the history of digital assets. The days of just operating in some regulatory gray area are completely over, and that new clarity has fundamentally changed how capital flows into this space. So how did we even get here? Well, it started with those niche cypherpunk origins, but the real game changer was January 10th, 2024. The SEC's approval of the Bitcoin spot ETFs, that was the crack in the dam. It just opened the floodgates for institutions. By 2025, giants like BlackRock and JP Morgan weren't just dipping their toes in, they were going all in on tokenization. And the final piece of the puzzle fell into place on January 1st of this year, 2026, with that Global Tax Reporting Framework, CARF, finally going live. And that really gets to the heart of it. A massive global pivot away from regulatory skepticism and random enforcement actions to clear, predictable rules of the road. This shift gave institutions the legal and compliance green light they absolutely positively needed to enter this market at scale. It's not about guessing the rules anymore. It's about operating inside a defined, understandable system. So, what do these new rules actually do? Well, three things are absolutely crucial. First, the Genius Act. It allowed vetted fintech firms to get national trust bank charters, which legitimized things like custody and stablecoin issuance under federal oversight. Huge. Second, CURF, the global tax net. It basically ended the days of hiding assets by creating automatic reporting standards. And third, maybe the most important for the market's maturity, is that traditional banks are now fully integrating digital assets, even accepting them as collateral for loans. This weaves crypto into the traditional financial plumbing like we have never seen before. All right, so with that new landscape set, we can finally turn to the assets themselves. And this is what we call the great asset sort. It's that critical process of sifting through everything and separating real foundational value from all the speculative noise that's still echoing from the last cycle. It's about asking not just, what is this token, but what real-world claim or utility does this thing actually represent? And right at the heart of this sort is real-world asset tokenization, or RWA. This isn't about creating new value out of thin air with code. It's about making existing tangible value way more efficient. Think of it like this. Instead of a paper deed for a building or some certificate for a bond, you have a digital token on a blockchain that represents your legal ownership. The real magic here isn't just that it's digital, it's what that lets you do, like own a tiny fraction of a skyscraper or trade a corporate bond almost instantly. So how does this actually work in practice? It's basically a three-step process. First, you identify the asset. Let's say it's a portfolio of US Treasury bills. Second, and this is the most critical step for making it legit, you put that asset into a legally recognized structure, like a special purpose vehicle, or SPV. This protects the asset and makes sure the token holder's claims are legally sound. Finally, you issue digital tokens on a blockchain, where each token is a verifiable slice of ownership in that SPV. These transactions then settle on blockchains, often using super efficient layer 2 networks to keep fees incredibly low and speeds high, which is an absolute must for institutional-grade finance. And listen, this is not some niche little experiment. As of this year, 2026, the on-chain market for these tokenized real-world assets has already rocketed past $35 billion. This isn't a future prediction. It's what's happening right now. This number represents a massive migration of traditional value onto modern, way more efficient blockchain rails. But the growth of this transparent, legally backed world of RWAs really shines a harsh light on some of the darker, more opaque corners of the market. And this brings us to the brutal truth about what so many people used to call DeFi yield. And that subtitle, that isn't just a clever phrase. It is the single most important lesson from the last crypto bubble. If you can't find the yield, you are the yield. So we have to ask the hard question, right? When some protocol is offering you a 50% or even a 500% annual yield on your deposit, where is that money actually coming from? Is it coming from real lending fees, trading revenue, or is it something else entirely? The answer is what separates a sustainable investment from a high-stakes game of musical chairs. This table just lays it all out, plain and simple. On the left, with RWAs, the yield comes from real-world external cash flows. Interest payments on a T-bill, rental income from a property. It's auditable, it's transparent. But in contrast, so much of that unsustainable yield in DeFi was just the protocol printing more and more of its own token and giving it to you as a reward. It's just a closed loop funded by inflation, with opaque and often totally unverified reserves. This is exactly why that old metric, total value locked or TVL, was so misleading. It didn't represent real capital, just the inflated value of the protocol's own funny money. And if you need a case study in why transparency is so important, we'll look no further than this famous Bloomberg headline about Tether. The endless questions over the years about whether its reserves were actually fully backed just highlighted the massive systemic risk of these opaque financial structures. It's a permanent reminder. If you can't independently audit and verify the assets backing a token, you have to question the yield it supposedly generates. So, okay. After seeing the pitfalls of chasing phantom yield and understanding this whole new landscape, how do we navigate this complex world? How do we actually tell the difference between real value and a cleverly designed trap? Well, we need a framework, and not some crypto-specific framework, but a timeless one that works for stocks, bonds, real estate, and yes, now for digital assets. We call it the 4 pillars of investing. It's a complete 360-degree approach that forces you to look at an investment from every single critical angle. Its fundamental strength, the market's psychology, how it's actually going to generate cash, and most importantly, how you protect yourself if you're wrong. Let's break them down with some 2026 examples. Fundamentals, that's about intrinsic value. For a tokenized T-bill, the fundamental is the creditworthiness of the US government. Simple. Technicals, that's market psychology. Even a safe asset can be overpriced. Cash flow is about how it pays you. A tokenized bond pays a predictable coupon. And finally, risk management. This is your plan to protect your capital. For altcoins, the big risk now is regulatory. For an RWA, it might be the credit risk of the issuer. The bottom line is, before you invest a single dollar, you have to know your exit plan. Okay, time for our final section, putting it all together. Let's apply this 4 pillars framework to the new digital asset landscape and actually see what a modern, intelligent portfolio looks like here in 2026. First things first, we have to bust a myth that just refuses to die. For years, people claimed crypto was this uncorrelated hedge, like a digital gold. Well, the data is in, and it proves this is just plain false. With a 70% price correlation to stocks, major crypto assets act like high-beta tech stocks. They are risk-on. When global markets get nervous and sell the Nasdaq, they sell crypto too. It is not a safe haven. I mean, this data from just a few months ago paints a really clear picture. The crypto fear and greed index was at extreme fear. Recession probability was taking up, and that correlation to stocks was locked in high at 70%. This shows that crypto is no longer some isolated asset class. It's deeply woven into the global macro environment, and that makes our 4 pillars framework, especially risk management, not just helpful, but absolutely essential for survival. So here's the crucial point. What we're seeing is just the next logical step in the evolution of a diversified portfolio. In the 80s, it was a simple mix of stocks and bonds. By the 2000s, alternatives like real estate became standard. Today, in 2026, the modern portfolio includes a 4th category, tokenized assets. And these are primarily those RWAs we talked about, which can offer bond-like yields but with the transparency and efficiency of a digital wrapper. And that leaves us with one last fascinating question.
The lines are blurring so much they're almost gone. Traditional finance is adopting the tech of crypto, while crypto is adopting the assets and the rules of traditional finance. So as these two worlds completely merge, the whole distinction between crypto investing and just, well, investing might disappear entirely. We may just be looking at the future of finance. Full stop.